2-1 already, and it's me, Eric, back with Option Edge. As you can see, I'm wearing my blue blockers. It's late at night, and I'm trying to protect my retinas from that harmful blue light. Anyway, let's get into it. I'm looking at Apple, okay, and as you can see, Apple is starting to get very, the volatility is dropping like crazy. You can see the Bollinger Bands here, which is basically a volatility visualization tool with one standard deviation in price below and one standard deviation in price above it. And you can see it's contracted greatly. Okay, and then what I have here is the Bollinger Band width, which is the measurement of the top band to the lower band. And as you can see, let's zoom out a little bit. And I'm going to go ahead and throw a line on here just to give us a little bit better of a... So throw the line right there. You can't really see. Let's look at the last time we were this low. The last time we had volatility this low was, it's hard for me to see, looks like maybe November, December of 2019. So 2 years ago. So this is the lowest volatility in 2 years, okay? And so what I did, and this isn't actually my idea. I took this from Stephen Place. I'm a big fan of his. But we decided to buy a strangle, okay? So we bought the 125 call and then bought the 125 put. This way, if it breaks the downside, we're covered. But we have a bias towards the upside. And if I had to, if I was a betting man, I would say I think we're gonna make the break to the upside. We're right on the 200-day moving average. But so let's look at what that looks like in E-Trade. Just a little profit loss visualization graph. So we will make money to the upside if we hit the 131 mark, and that's on expiration, okay? But before then, so we're looking at the other line. The yellow line is the P&L upon expiration, and then the blue line is P&L. I set it to an arbitrary number, June 24th, a couple weeks away. So $100 if we get to that before on the 24th. So then we have a little bit more ways to go on the downside. 113 is the break even. But here's the thing: implied volatility is so low. Here's implied volatility. Let's say for sakes that it goes up to, I don't know, it goes up by like 7. So now it's gonna be at 32. So let's see how that affects things. If it goes up to that, then you're gonna see that although our break evens are still the same, but look at where on June 24th, where our P&L then. So basically, if we get a spike in volatility in between now and then, this is gonna rise up in price, and we're gonna go ahead and take a look at that. So here, let's look at in 2 weeks from now, if we break to the downside. And if we hit the 117 mark, we're going to be profitable on the 24th. So, and then let's say we see a massive spike. Let's jack this up to, let's say, 40. I'm not saying this is going to happen. This is just a little thought experiment. 40, boom. Okay, now you can see at 131, which is our break even, 130. There we go. We're going to be $400 profitable if we were to hit that. At the 131 mark, and there you can see let's move this. Let's see how far we can move this down. So even if we're below where we currently are, that call would be profitable. So that's an interesting little tool to use to visualize. So I went ahead and bought the 125 call and the 120 put. I bought this a couple days ago. So far, up about 8%, which is good. Just bought one of them. If for some reason Apple doesn't break out, and the main risk here is theta decay. So if we somehow land, we don't move much at all, these options will eventually decay and be worthless. So that's the main risk here. So we might open up another trade at the $4.50, and if that, just to get ourself a better entry point, and then be out at 250 if it just continues to die. But I really don't think that's going to happen. And another thing to think about, on June 30th, that's 30 days before earnings, and historically Apple has made an earnings run. So I think we'll maybe catch the tail end of that. And then, so right here, this indicator here is the average true range. So this just shows you in a day how much the price of the stock fluctuates. So this is showing about $2.30 is the average volatility, the change in price. So if we just get 2 days going, so we're currently at what does that say? 127. So basically, we just need we need 1 day, 2 days to go to the upside, and we're profitable. We're in that 131 range. And then below that, this right here is it's something called the TTM squeeze. So basically, it's another measurement of volatility. When volatility gets really low, this prints red dots. And if we just do a little visual back testing, let's see the last time it printed red dots. You can see it made a big break to the upside. Okay. The red dots mean that it's going to make a break. It could make a break to the upside or the downside, but basically it's a good way of, well, we didn't really have much of going back in time. We really didn't have, wow, this is crazy. No squeezes in Apple for how long are we? This is going back 3 years. Anyway, so that just shows you that, I think we're due for a big pop, and let's go, if we go to Tastyworks, this shows us our overall delta. So our directional exposure is about 38, so we're about 38 to the long side. Extrinsic value is that, max loss 595 is what we currently paid. Probably a profit 45%. So yeah, that's the trade. I'm pretty confident that we're going to see a big move soon. So hopefully, if anything, even doing a call debit spread might be something that would work. But overall, that's the trade, guys. Hope you guys liked it. Like and subscribe if you find this stuff useful. I'm going to be putting out some informational stuff for beginners, because it was only 3 years ago I was doing this stuff, and now I think I've gotten some good knowledge, and I think I can start teaching it a little bit. So anyway, if you have any questions, please reach out. Alrighty, bye-bye.